Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we've had such a good run until now. I suppose a little rain must fall into our world, and indeed that has been the case in the last week. So let's start off with last week's trade, in fact, which was AngloGold Ashanti, and it hasn't worked out very well. So let's go through that.
Unfortunately, it hasn't worked out, and we've been stopped out of this trade. If we just have a look at the chart of this up on the screen now, what I'd seen here was that we had this head and shoulders pattern on AngloGold. But then we had actually broken out above the top of the right shoulder. And I then said, well, that's a failed head and shoulders, or you might also consider that to be a falling wedge pattern that was then breaking to the upside.
Yes.
And that is typically a bullish pattern. So I went long on that basis. I bought 500 CFDs for us at 191 Rand per share, used a stop loss at 179 Rand. Now, unfortunately, it hasn't worked. As you can see, the stock just basically rolled over, and I've ended up having to stop that trade out at 100. I cut it at 178 Rand 30. Remember, I don't use manual. I don't use automatic stop losses. I use manual stop losses in my trading. So I cut it at 178 Rand 30. It's just below where our stop loss level was, and unfortunately, that yielded us a loss of 6,720 Rand after costs. So around about 2% of our trading capital is gone on this trade, unfortunately.
Unfortunately. And Garth, what about Anglo Platinum? So the resources sector, I mean, you've still made money on it, but it has kind of looked a bit soggy after shooting up quite nicely at one point, and you can, I think that was a bit of an odd trade, but certainly it has come back.
Yeah, well, if we have a look here, so Anglo Platinum, we've had this trade on now for probably 2 months. And we've been sitting tight, and it's been working very nicely for us. What I'd identified was that triangle pattern that I've pointed out on the chart there. And I went long at 370 CFDs at 450 Rand per share. And I put in an initial stop loss at 435 Rand. Now, the stock's been moving up. As you can see, it's been making these nice, steady, step-like moves to the upside. And I ratcheted the stop loss up as we went. Now, we basically had this nice steady rising trend there that you can see indicated by that dotted line. And when it started to break below that rising trend, that was my signal to actually then cut this trade. So I closed it out at 494 Rand and 50 cents. That made us a profit of 15,554 Rand. So still a good profit. Remember, my initial target here was to look for a move to 515 Rand, which we didn't quite get. And I suppose I held out hoping for that, and didn't happen in the end. But nonetheless, we've made good money on this trade. We've locked it in now. We move forward.
Sure. I mean, you could have had nothing. I think you could have had about, 19,000 or 20,000 at one point.
At one point.
Because we certainly were up there. But that's trading. It's never perfect.
No.
Garth, now this week's show, you want to talk about option structures, which can be quite tricky. And I know you want to start off with the June top 40 option structure that you have on the go at the moment, which probably isn't going to work out given where the market is at the moment, i.e. record highs.
Yeah, probably not. And I mean, these things are quite tricky. So, and I know I'm going to get a bit of feedback from viewers saying this type of stuff is too complicated. Watch and learn. It's these option structures are really interesting, and they are available now to trade if you're a retail player in the market, and we can talk a little bit more about that just now.
Okay.
So we need to progress and so learn. I mean, there's a lot of interesting stuff to be done within the option space, and to protect your risk and so on. If we have a look at that June options contract that we spoke about, or that you've mentioned, this is something we did earlier in the year. I put this trade on in February, and this trade runs out to the 19th of June, which is still around about 6 weeks' time. So anything can still happen from here on out.
Sure.
But really, that's the net payoff of this structure. We've got the graph of the top 40 on the left-hand side here, and then there you can see June is where the futures closeout would be, the 3rd week of June. Now, what would happen is if the market were to end below 42,500, this structure then starts to make quite nice money. It makes its maximum profit at 37,500, and then it begins to give that profit away, and at below 35,800 it would lose money. Now, the thing is, we are now currently sitting up here north of 44,000 at the moment. So looking at it as it is right now, it seems to me that it's probably unlikely that this structure will work for us. Nonetheless, I'm glad to have had it on in the background because it is downside protection. And remember, it's free. It's like a free short. If the market continues to go up, I lose no money on this. But if the market had gone down into that zone of profitability, then we would have been looking quite good. But as I say, I think it's getting late in the contract now, or late in the quarter for this futures contract. It is looking unlikely that this one is going to work for us. But that then leads me to want to put another one on for the next quarter. And I'm going to talk now about an option structure, very similar type of structure that I've done for the September futures contract, which gives us downside participation if we should see some sort of a market pullback between now and September.
Because everyone does seem to be bracing for a market correction. They just don't know, well, we don't know what the catalyst may be, the quantum, but I suppose people are hoping for some sort of 10% pullback because it has got quite steamy.
It has gotten rather hot, and there are obviously many commentators out there talking, saying the market's, it's run very hard. It probably is due a breather. This time of the year, sell-in may go away. The second quarter in June, July sometimes are quite weak months in the market. So I still think that is a possibility. But the thing for me is I just don't like being naked short in the market, generally speaking. Being naked short means that if the market continues to run, then you're going to lose money. If the market falls, then you're going to make money, obviously. But the thing is, we're in a rising market. It's a bull market. We have to accept that fact. So being naked short in a bull market is not a happy place to be.
No. I mean, you could be naked long too, which may be a happy place.
Sure.
Well,
we have had some good long positions on in our portfolio, which have worked for us. But I like having this protection on in the background in the event that we do see a market pullback. And the thing is, these things can happen when you least expect them, and they can usually be quite violent and quite vicious when the pullbacks do happen. Doing it this way, having option structures on, like I'm going to put on here, allows me to have a short position on with effectively no risk if the market continues to rise, but it will give me participation if the market should begin to pull back.
Okay.
So let's look at it and see the mechanics of what I've done here. Now this chart that I've got on the screen here, along the bottom axis, we've got the levels of the top 40 at the moment. So there you can see 41, 42, 43, 44. At the moment, we're north of 44,000, around about here. On the left axis, we've got the profit and loss. Above the line here is profit, below the line is loss. Now, the option structures that I've put on are as follows. I've gone along and I've bought a call option, or bought two call options for the September futures contract with a strike of 44,750. I've paid 15,000 Rand for each of those options, which means that I've paid just over 30,000 Rand as a total cost. Now that's a lot of money to pay away.
Sure.
And hear me out as to why I'm doing this, because you might think, why am I going long of a call option if this is supposed to be downside protection? But watch. Right, so what I've done against that is I've shorted a put option. I've shorted 4 put options actually with a strike of 41,750. For those, I receive a premium of 7,431 Rand for each of those put options. The premium received, therefore, is 29,724 Rand. So very close to the 30,000 Rand that I had paid for the call option. So in other words, these two options structures are self-funding. The cost of the one is offset by what I receive on the other one. So if I put that yellow line on there, that is now the net payoff of these two option strikes. Between 41,750 and up to 44,750, I've effectively got pretty much no cost at all. If the market goes above 44,750, then this structure starts to make money. Below 41,750, it starts to lose money. Okay, again, you're probably still saying to yourself, but if this is supposed to be a bearish structure, that's not a bearish payoff. What is going on here? Let's tidy it up a little bit and take this one step further. That's what the net payoff of the two options profiles looks like, overlaid against each other. Now, this is where the negative or the bearish part of it comes in. What I've done against that option structure is I've gone short of 2 September top 40 futures at a level of 44,600. Remember, this is the September futures contract.
Yes.
So this is one contract period out from where we're trading currently. Now, as you can see, if you look at to the right-hand side of the chart here, what the gain would be on that option structure is offset by losses on the short futures position. However, this short futures position will make money all the way down below 44,750, and that short position will continue to make money all the way down as the market falls. Now, if I overlay these two profiles against each other, we get that orange line that I've introduced onto the chart there now. So let's tidy it up one more time. What it basically means is that this is now our total payoff that we're looking at for this structure for the next quarter. Above 44,750, this structure has effectively costs me 3,434 Rand. That's the maximum amount of money that I can lose on this structure.
Okay.
If the market starts to fall, it then makes its most profit at 41,750. At that point, I can make 56,000 Rand profit. All right. That profit then starts to dwindle away if the market should fall further, and below 38,750, then I start to lose money. So you've got the green area there, which is the area of profitability, and then the red triangle to the left-hand side, that's what I call the danger zone. If the market really gets a serious hammering, then we would fall into that danger zone, which would be a problem. But I can also hedge that.
Yeah, but that would be a serious hammering. That's what at least 20% away from.
Well, 38,750 on our top 40 would be around about 13% below the current level. So what I'm looking for here really is anything below current levels down to around about a 13% correction. That's our area of profitability. If we expect the market to at some stage during the next quarter, or during this next contract out to the September futures closeout, to pull back 6, 7, 8, 9, 10%, something like that, then this option structure is very, very nicely suited for a pullback in the market like that. And as I say, if the market should continue to rally and continue to move higher, the maximum loss that I incur on this structure is 3,434 Rand, which is something I'm quite happy to pay away, knowing that I've got this really nice downside participation if the market should fall at some stage.
That's the maximum loss, and then the cost is the difference between the 29,700 and 30,200.
Yeah, well, that's all factored into that 3,400 Rand figure.
Garth, we're overlaying that against where we are in the market.
Yeah, let's quickly have a look. So now this first of all, that was the June structure that I showed you earlier, right? We've still got this one on, and we will leave this on right up until futures expiry in June. Now, if I introduce this new structure that I've just done for the September contract, here you can see basically I've plotted it right in September over there on our chart. Below 44,750, this structure makes money. It makes its maximum profit at 41,750 on the top 40, and then it starts to give back that profit below 38,750. We would start to lose money on this structure. I don't know whether this will work or won't work. I suspect at some point between now and September, there's a fairly strong likelihood that we will get a reasonable pullback in this market, and then this structure is really going to sit very nicely for us if that should happen. If not, it really doesn't matter. It's like a free short. It's not quite free, but it's very cheap. And the risk, if the market continues to rally, there's no chance that I'm going to get squeezed out in a short squeeze or anything like that. So I can quite comfortably sleep at night knowing that I've got this protection in place.
Well, that's it, isn't it? Because people will ask, because you have done a number of these option structures, they have a lot of them expired and you've made nothing at all whatsoever out of them. But that is, it's just a certain peace of mind and a hedging against a loss in the market.
Yeah. Well, it's like insurance. You don't get excited when you don't have to claim on your insurance. You know what I mean? But when you do need to claim, you're glad you've got it. And that's kind of what this is. This is like an insurance policy for the market coming lower.
Garth, very quickly, before we get onto the portfolio and upcoming courses, which we'll have to cram into 30 seconds, easy enough to do this as a retail investor. You are a market professional, but you did talk about a company that's making markets and structures.
There are prices on SAFEX on the screens at the moment in retail options. The market maker is Applied Derivatives. He's sitting there on bid and offer and options in 5 contracts on each side. So theoretically, these things are actually now available to the retail public to trade.
Okay. Garth, so what does the portfolio look like then?
All right. Well, we have had a bit of a poor week, actually. We've just gone back under 300,000.
Yeah.
We're still up 20% for the year to date. So it's still a good story. Our Anglo Platinum profit 15,000 Rand there, and our AngloGold lost 6,700 Rand. And then these are the 2 option structures which we've discussed on the show today.
Okay. And Garth, just to end off with your next course date.
Yeah, I'm doing a whole series of courses throughout the country. You can see them up on the screen there. Understanding CFD courses on a Thursday evening and a high probability trading course on a Friday in each of those venues mentioned there. If you'd like to attend any of these courses, you're welcome to email me, garth@traderscorner.co.za, and then I'll send you the details.
Okay, great. And obviously people can review this video on both your website and ours if they're a little bit confused. Garth, thanks as always for coming to the studio.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.